Imagine this. Tension between the world's two largest economies turns into a real conflict overnight. The sound of the first explosion is heard far away. But the first blow to your city comes not from a missile, it comes through prices, supply delays, and market panic. Because this war would not only hit armies, it would strike the nerve endings of the entire global system. The United States and China have been rivals for years. But being rivals is one thing, open war is another. The problem is that these two countries are not just political rivals, they are also two giants, deeply connected inside the world's biggest production, consumption, and trade chains. U.S. goods trade with China reached about $582 billion in 2024, and despite all the rhetoric about separating, that shows the system is still deeply tied together. In 2024, U.S. goods imports from China remained around $438.7 billion, while U.S. goods exports to China were about $143.2 billion. These numbers make one reality clear. If war started, the shock would not stay on the battlefield. It would hit supply, production, and pricing systems themselves. When ties of this scale break, shockwaves spread across every market. The first major shock could appear in financial markets. The moment war headlines break, investors would likely flee risky assets, insurance costs would rise, shipping rates would jump, and energy and industrial companies would move into a new risk assessment mode. This would not be just a the stock market fell story. It would be the global pricing mechanism suddenly switching into fear mode. The second blow would be felt in supply chains. In the modern economy, products are not simply made in one country. They pass through dozens of countries before reaching their final form. So, if a military clash erupts on the US-China line, the problem is not just trade between two sides. It is also the production rhythm of third countries, operating through those same networks. One of the most critical pressure points is the semiconductor ecosystem. The world is now dependent on chips for AI, data centers, automotive electronics, industrial automation, and defense technology. Any major regional military risk affecting chip flows could squeeze multiple industries at once, from smartphone production to auto assembly lines. This is where the Taiwan factor moves to the center of the scenario. According to CSIS estimates, about $2.45 trillion worth of goods, more than one-fifth of global maritime trade, passed through the Taiwan Strait in 2022. If serious military disruption hit that route, it would damage not just the region, but the rhythm of global trade itself. The importance of this route is massive for U.S. allies as well. CSIS estimates show that a large share of Japan's and South Korea's trade passes through the Taiwan Strait. That means a U.S.-China war would not remain a two-country war. In logistics and industrial terms, it would immediately affect many countries at once. Energy markets would react immediately too. War risk and maritime transport danger could drive up oil, LNG, and shipping insurance prices. Even in 2026, Reuters showed how U.S.-China trade tensions were already reshaping LNG flows. Even without directly importing U.S. LNG, Chinese companies remained active in the global LNG game through long-term contracts. That fact shows how deeply connected the system is. Even under confrontation, flows still move indirectly. In a war scenario, however, that indirect movement would become more expensive and more chaotic. Changing a tanker route does not just affect fuel distance. It also changes insurance, delivery times, contract risk, and price expectations. As a result, an energy shock would be felt not only at the gas pump, but across electricity markets and chemical industries as well. Inside the U.S., one of the first visible effects could be renewed inflation pressure. If intermediate goods, electronics components, and consumer products linked to Chinese supply chains become more expensive, that price chain would eventually reach store shelves. In other words, a political war decision would show up later in household budgets. Inside China, the damage would not be measured only by export numbers. External demand, shipping risk, financial flows, industrial rhythm, and investor confidence could all be squeezed at the same time. In wartime conditions, production capacity alone is not enough. If routes are not open, insurance is expensive, and buyers avoid risk, a factory running is not the same as stable product flow. In this scenario, the technology front would harden quickly as well. The U.S. has already tightened export controls on advanced chips and semiconductor technology in recent years, and BIS keeps separate consolidated materials for the 2022-2023 rules and updates. If war broke out, those restrictions could expand into much broader and more aggressive controls. The same pattern appears in investment policy. In 2024, the U.S. Treasury finalized an outbound investment security regime and announced that the rules would take effect in early 2025. Target areas include semiconductors and microelectronics, quantum technologies, and certain AI sectors. In a war scenario, this model of selective restrictions could shift into a much harsher regime of wider bans. That would create a new fracture in the global technology sector. Companies would suddenly face questions like, which market do we stay in? Which standards do we follow? And which chips can we sell into which country? In other words, war would not only be a physical conflict, it would accelerate the political fragmentation of the technology ecosystem. Another critical consequence would be insurance and shipping. As soon as war probability rises, shipping companies would raise risk pricing, impose surcharges on certain routes, and some carriers might withdraw from routes entirely. These changes would create delay inflation in global trade. Goods exist, but they do not arrive on time. They arrive, but at higher cost. This scenario would also force allies into difficult choices. The U.S. would try to harden a security bloc, but European and Asian partners would have to calculate both security risk and economic cost at the same time. So the real question would not just be, who is on whose side? It would become, who is ready to pay what economic price? Global financial flows would also feel the shock. Flight to safety, demand for dollar liquidity, pressure on regional currencies, and capital outflows from emerging markets could all appear in waves. IMF work on geoeconomic fragmentation has already shown that deeper fragmentation can impose serious costs on global production and welfare. War would be the harshest form of that fragmentation. One of the most dangerous outcomes would be not the direct hit, but the chain reaction. For example, a disrupted sea route in one region slows electronics supply. That reduces auto production. And that then affects work hours and prices. A war headline could begin in one country and end as a factory slowdown on another continent. The information and cyber front would open in parallel. Critical infrastructure, port management systems, logistics software, financial networks, and communication systems could all become targets. When physical war and cyber pressure combine, the economic impact grows twice as large. Because the problem is no longer only the movement of goods, but the disruption of information and control systems themselves. For the U.S., the hardest political challenge would be this: maintaining a hard security posture while preserving domestic economic stability at the same time. For China, the challenge would be holding together export strength, industrial rhythm, and internal stability simultaneously. In other words, both sides would face an economic endurance test before the battlefield decides anything. In this scenario, even the meaning of winner changes. In a war like this, it is not only about who has more weapons. It is also about who can endure economic pressure longer, who can rebuild supply chains faster, and who can manage alliance networks more effectively. These factors would shape the outcome too. That is exactly why a US-China war scenario looks less like a normal regional conflict and more like a global system event. The front line would not exist only on maps. It would run through ports, data centers, chip plants, insurance markets, energy contracts, and everyday price tags. And maybe the hardest truth is this. If such a war began, the world would ask, who won much later? In the first phase, everyone would feel the same things: higher prices, uncertainty, delays, and risk. The modern global economy is so interconnected that a clash between two giants would not just shake them, it would shake the system itself. If this scenario needed a one-line name, it would not be a war between two countries. It would be a combined shock of global supply, energy, technology, and finance. Missiles would dominate the headlines, but the real damage would often move through invisible lines. Because in this era, war is not only fought over land. It is fought over production rhythm, chip flows, route control, and economic endurance. And if two giants like the United States and China collided, the world would feel the word war, not only at the front, but through the entire nervous system of the global economy.